Park Place Investment welcomes you to another episode of Investment Cubed, where we talk about the world of commercial real estate and real estate financing, Silicon Valley and technology startups, and investment and personal finance.
Welcome to another episode of Investment Cubed. Today we have Chris Salerno of QC Capital on our show to discuss his latest offering, which is a 144-unit complex in Greenville, South Carolina. Chris believes investing in real estate is the best building block for financial freedom. Soon after relocating to Charlotte, Chris developed an extreme passion for real estate. By the time he was 24, he had successfully transacted more than $40 million in real estate volume and helped lead the #1 real estate team in the Carolinas to produce more than $145 million in annual sales. Named to Charlotte's 30 under 30, Elite 50 entrepreneurs, 30 under 30 entrepreneurs, and nominated for Forbes 30 under 30, Chris has quickly gained recognition and notoriety for his hard work and dedication. Chris is also the founder and host of the Mindful Multifamily podcast. Through Chris's vision, QC Capital has quickly become a well-respected real estate firm. Let's welcome Chris to our show. So Chris, welcome to the show. Please tell me a little bit about yourself and how you got into real estate.
Yes, thank you so much for having me. Very excited to connect with you guys and to work with you on this particular asset. So I was born and raised in the real estate industry. Father's been a broker over 45 years in the state of Florida. And I started out in the residential industry, grew a small team selling residential brokerage here in Charlotte, North Carolina, which I've lived here over 13 years. Grew that small team. I merged that team with the #1 team for Keller Williams in the Carolinas at the time. And I really fell into their operational role. I always loved and was intrigued about businesses on why they failed, why they were successful. And I was able to make them 46% profitable in 1 year compared to 3 years of being stagnant with no growth. After that, I felt like I hit a ceiling. And I started studying the '08 crash and realized that multifamily was the strongest asset class and it recovered the quickest. Also, the economies of scale. I started educating myself on it, and that's when I created QC Capital. And very quickly, we acquired 3 assets, a little over 363 units, and a little over $40 million worth of real estate just within 7 months of us opening shop. So we're very excited about what the future holds for us and in Lionsgate asset, which we're going to be chatting about briefly here.
That's great. That's great. You've risen and top pretty fast.
Yes, very much. This is a team sport and life's a team effort. And we all work together as a team. We can all grow and reach our goals a lot quicker. So as long as you do that, I think you'll definitely be able to hit your goals.
Absolutely. Well, that's well said. Do you want to tell me a little bit about Lionsgate, also about the city of Greenville and also the property itself?
Yes, very much so. So I'm in Charlotte, North Carolina. I'm about an hour and 40 minutes from Greenville. Greenville sits between Charlotte and it sits between Atlanta, Georgia. So if I drove to Atlanta, it'd be about 4 hours, and Greenville's that middle point on 85. Clemson University butts right up to Greenville, South Carolina. CBRE just released a couple months ago that Greenville, South Carolina is the top emerging industrial markets for 2020 and 2021 in their vision for the United States, which is very exciting. And I really think that's because it sits right there on 85. You have 2 large cities right between there. And real estate for industrial, there's a lot of real estate to be built there. And we're seeing that when it comes to industrial. You have BMW's headquarters there. You have Michelin's headquarters there. All of BMW's cars, all their M-Series cars are built right there in Greenville, South Carolina. So they build them there. They ship them down to Charleston, and then they ship them over to Germany or wherever in the United States. So that's a very interesting fact. And they're actually doing it's a $1 million it's 1 million square foot addition to the BMW plant because of the demand. So it's huge in industrial, and we all see that industrials is going to keep picking up because of the e-commerce business, which we're very excited about. And it also got ranked top 5 places to retire in the United States. So it's a wonderful city that sits right between 2 very large cities. And a lot of people are moving there because of the jobs and the lifestyle and the outdoor lifestyle that it brings.
Sure, that sounds like, yeah, I mean, from what I've read, there's a lot of commercial real estate development and going on in that area. So it sounds like you're kind of in the right place at the right time to really make this asset shine and stand out.
Very much so, yeah. And in another, I'm going to say I love it, one reason, but I love this asset, multiple reasons, is that if you look at the CoStar report, which is on the website, the CoStar report shows that the average price per door is $129,000 for the Greenville, Malden area, which Malden, South Carolina, just sits a little southeast of Greenville, but it butts right up. It's still Greenville County, and the CoStar report says it's $129 per unit average. We're buying in at a little over 95 per unit. So if we did exactly nothing to the property, if we just bought it and just sat on it and did nothing, we are already, give or take, a $30,000 spread difference compared to where all the other properties are currently trading for. And that's just something that I love, and it's very hard to find that with how hot this market is, especially how the market is here in the Carolinas. It's just very difficult.
Yeah, that explains why the, some of the amazing financials that you're projecting. Can you talk to us about a little bit about those?
Yeah, so we always like to tell everyone and revert back to the sensitivity analysis, which is on page 22 of our OM, so you can get a really good idea. It's page 21 and 22, a really good idea of the breakdown on how the property is going to perform. We are underwriting very conservatively too. We've all seen operators underwrite very aggressively, but we tend to be the conservative approach, and we know when to be aggressive because we actually live in these markets, so we know where to be aggressive as well. So first year, we're underwriting at 0% rent growth. Second year, we're underwriting at 2% rent growth. And year 3, it's 3%, and then 3% until year 5. Our plan is to exit the property in year 5. So this is a 5-year hold. I do strongly feel by implementing our business strategy that we should be able to exit sooner, but this is a 5-year hold, so we're going to shoot for that 5 years. Obviously, if we can get out sooner, we'll definitely do that because that's just going to bring better returns for everybody. And keep in mind, this is a 506C, so it is only open to accredited investors who qualify. But that's one thing that I've seen that operators, even during COVID, are underwriting at a 3% rent growth year 1. Which we just are not willing to do that. We like to be on the conservative side. When it comes to expenses, we're actually underwriting around 100. We budgeted and underwrote 150,000 more than what the property manager projected to us for expenses. So that's another large cushion that we've underwritten, which are projecting these returns. And on the sensitivity analysis, you'll be able to see the returns for best case scenarios at 18.9, 19% IRR for Class B members, and then just averages around 16.8, 16.9. So if we don't do anything to the property, even with still being conservative, but no renovations, no rental increases from those renovations, we're at around a 16.9. In worst case scenario, it's around 14, 13% IRR. But I always like to say, if you go check out the sensitivity analysis, you can really get a good idea on the returns for this particular property.
Great. Yeah. By the way, we put those docs on the Park Place deal page for Liongate. So any of our investors that want to look at it, you should go to Chris's page and you'll see those documentations. You mentioned something about Class A and Class B. Do you want to talk a little bit to the investors about that?
Yes, I'd love to talk about that. I would say we started about six to 8 months ago, the different type of classes, Class A and Class B, and I'll break those down here. Is Class A is a 9% preferred return. That 9% preferred return is paid out. That's an annual return, and that's paid out on a monthly basis. So we do monthly distributions. The difference is in that Class A gets paid first before Class B gets paid. And then Class C is the general partners. And Class A is the 9% preferred return annually with monthly payouts. You do not get to participate in the sale of the property. So you're receiving a 9%. When the property sells, you do not get to participate in any of the profits or the proceeds for the property. You're just going to get your 9% across the board for those 5 years. That class is a minimum of $100,000 investment. Class B is a 7% preferred return annually, and that's paid out on a monthly basis with monthly distributions. You do get to participate in the sale of the property, which were the IRRs that I explained a little earlier on the sensitivity analysis, and that is a minimum of a $50,000 investment. The reason why investors like the Class A and Class B is because you are able to put some money in Class A and put some money in Class B. So you can really, diverse your investment by having a little bit in Class A, a little bit in Class B, so you can get more cash flow on a monthly basis, but then you can put a little bit for the upside when the property sells. And then Class C is where all of the GPs are in. So Class C is the GPs. And in Class C, that is where that after Class A and Class B has hit their pref, then that's when Class C, where the GPs will get some of the remaining cash flow. The split is 70-30. So 70% goes back to the investor and 30% goes to the GP at that Class C. But Class A has to get paid, then it's B, and then C. And at that C, it's a 70-30 split.
Yeah, that's a great setup. I think that's actually very attractive to a lot of investors. Well,
yeah, and there's no hurdles too after that. I know some investors will do a 50-50 hurdle, or in favor of them, a 70-30 in favor of them. But we don't do any type of hurdles like that.
Well, yeah, thanks, Chris. Well, do you have anything else to talk about your current deal to our investors?
Yeah, we're very excited for this particular asset. It is a completely off-market asset that we were able to acquire from our relationships that we have with the broker. And we already own 2 assets out there in the Greenville, South Carolina area. And those are performing extremely well during COVID. Occupancy's been very high and collections are as well. So we're very excited on how those assets are performing. And we're just very happy to add this to our portfolio for the Greenville, South Carolina market.
Well, thank you for coming on the show. So, so to summarize it, this is a syndicated deal. It's a 506C exempt asset, only open to accredited investors, which all our investors are. And you could find it on www.parkplaceinvestment.com. Thank you so much for being on the show, Chris. I really appreciate it. And thanks for allowing us to partner up with you. Appreciate it.
Yes, thank you so much for having me. Very excited for this partnership and more to come. Thank you.